Hi there, Jack Foley from individualtrader.net. Yeah, just an update. Um, this video we are recording on the 3rd of May. As we outlined in a previous video, we believe the S&P 500 has topped. Even though it didn't tag its 200-day moving average, the NASDAQ actually did. So considering where we are in this timing band, of its daily cycle, the odds are pretty high that we're going to drop down into a daily cycle low here. But I think it's very important for traders to keep the end in mind when that low comes to pass, which could be in the next 2 to 3 weeks. Now, what do we mean by this? What we mean is that daily cycle lows, intermediate cycle lows, yearly cycle lows, and 4-year cycle lows, which we believe we had back in March, on the 23rd of March, when the S&P 500 dropped under 2200, provide the best opportunities for traders who trade cycles. Okay, now traders can buy stock ETFs, they can buy options, they can use a plethora of vehicles to expose themselves to long deltas, basically to put long deltas to work. And this is where one has to be very mindful of how their emotions can interfere with their trading. And let me tell you why. Just say we drop to 2400 over the next 2 weeks. Obviously, once we get a swing low, once we pass above the 10-day moving day average, and we have confirmed a new daily cycle low, well, then there's a big opportunity there for putting long deltas to work. Now, obviously, you get far more leverage out of options, out of buying call options, than you do out of buying stock. The risk reward is far better, and this is why we do not buy options, because they are extremely risky. I think there's some outrageous figure in terms of the amount of long call options that expire worthless every month. And the reason is that if you do not get the move that you're looking for in a specific period of time, well, then many people live in hope, traders live in hope after that, and they just let the thing expire worthless, which is really poor trading. But traders are greedy, and they look for more leverage way too often. Okay, it's that's a permanent loss of capital, which is not going to put you in good stead for your trading and investing career. So here, in situations like this, for traders, I think it's good to take a leaf out of Warren Buffett's book when he said his number one rule was to never lose money, never lose capital, and his second rule was to don't forget the first rule. Now, how can a trader adopt this mindset when trading in a more short-term manner or trading derivatives? Well, here would be a suggestion. Just say we fancy a stock in 2 to 3 weeks' time. It bottoms with the market, or even maybe an ETF that follows the main indexes. What you could do, depending on volatility, is that instead of buying a call option, you could sell a put option. So for explanatory purposes, let's just say this stock or ETF, this vehicle is trading at $20. We could sell the 19 put for $1, which means the break even is really $18. That's basically the cost price of that investment if you end up being assigned the stock. So by doing that, you're basically putting the odds into your favor straight away, because you are selling. You're basically, okay, you are capping your upside, but you are buying the vehicle below the price of the stock at that time. But what about if on top of that we bought the $21 call? Now we'll get into expirations in a different video, because the longer you go out in time, the higher the price the call option is going to cost. But just say that the put sale is the same, so the premium you receive from the put sale is the same price as the long call. So basically they're balancing out each other. Okay, so you're selling your 19 put for $1 and you're buying the 21 call for $1. So they're basically balancing each other out. What you're receiving in premium from the put sale, you're putting up to buy that call option. So here's the great thing about this type of trade setup is that you're given basically and the fundamental aspect is that you have no problem taking hold of this vehicle at $19 a share. That is the most important thing, and that's why it's all about fundamental analysis, technical analysis on the vehicle at 19 bucks. But just say that we do this, we sell the 19 put, we buy the 21 call. Because one premium is cancelling out the other, you're basically giving yourself a free trade. And this is how you can produce exponential returns, because you're giving yourself upside potential whilst keeping yourself protected. And this is what a lot of traders forget. They just, they see the leverage and they buy the call option instead of selling the put also. The problem is that if you sell the put, which is a cash secured put, you need the capital in your account to be able to take hold of that stock if you're put the stock. But what this strategy gives you is that if the trade goes against you and it goes to at expiration, you sold the 19 put and it finishes at 18, 17, well, you're long at 19 bucks. Okay, you're long stock at 19 bucks, which was basically you're getting a discount on the market because you sold it 5% lower than what it was. But by buying the long call, you're giving yourself upside potential, massive upside potential, because if that stock goes over 21, 22, 23, 24, you're going to make profit on your sold put and on your long call. Okay, so this would be the only strategy, the only time we would buy a call option or buy a put option is when we have some sort of insurance. We are either selling a cash secured put or selling a cash secured call. As we've stated before, and we'll state this again, and we'll repeat this constantly in our videos, trading and investing is all about putting yourself in scenarios where you have limited downside but significant upside. The more times you get yourself into positions like this, the more profit you're going to make over the long term. Okay, I hope you've seen the value in this video, and I'll see you on the next video.